When should we go, Jen? That's the
Well,
How
right
about now?
now you are
Right
currently
now. How
live
about now? There's
on
never a better time
YouTube.
than now.
never a better time than now. That is, I agree. So today, March 10th, 2025. This is Wall Street Beats. We have Robert Marson, Kevin Bakes Baker. I'm David Maris. We have a lot to talk about today, and someone's computer is so hot with picks. He's concerned it might shut down. Robert Marson. Let's talk a little bit about the names that you have. I think you're going to give us some cash. You're going to bring us back in time to WKRP or something like that. I don't know if we're going to Cincinnati or where we are with KRP, but for those that don't know the reference, by the way, who are under the age of 40,
Well,
WKRP was a TV show that was even a
very
little bit
clever.
before my time. But
Very
but
clever.
Robert Marson, take it away.
Well, I guess my current biggest position, and it's been accumulating over the past couple of months, is cash. So I guess I should talk about it since I consider this endeavor here, sharing my individual trades in real time. And over the last few months, I entered the year fully invested, even on a couple percent margin. But as the year has progressed, I had decided to take sell some winners and raise some cash. And then, as the market started to get a little heavy in the last week or two, I actively searched for other stocks that were very close to their highs. I know, Bakesy, I'm selling relative strength, which is bad. Worst thing to do in a bear market. I'm buying relative weakness. So, but that's the formula that I use. So I've continued to sell stocks that were, within 5 or 10% of their all-time highs, and trading at what I consider to be fair valuations. And I sold last week. I don't think it's too late to sell. I'm sure Bakesy would agree with that because the charts are starting to look a lot crappier today than they did 2 or 3 months ago. But I think having a cash position, if you've started and you want to get more, I'm not against selling more stocks. Selling your fundamental losers at lows, I'm fine with that, and selling your fundamental winners at all-time highs and fair valuations, I'm endorsing that as well. So that's the biggest position I have today, and I didn't want to ignore it. Second idea, guys, is KRP. We're in the mineral rights business, in the royalty business. It's Kibble Royalty Partners. It's about a $13.50 stock. I've mentioned this in the past at 14, and I think I did even mention it once at 15 because it had a 10% yield. Now that the fact that the stock has gone down a couple of dollars, I'm pounding the table for income. So if you need an income stock in your portfolio, it's an oil and gas partnership. It pays. It doesn't generate a K1 though, so you get a regular 1099, and it's tax advantaged. It's considered return of capital. So you reduce your basis by the amount of the annual distribution, and you pay capital gains tax when you sell your stock. So what's not to like about a 12% dividend yield today that is well covered, an under leveraged company. And if you ask me, mineral rights or royalties are the best way to own oil and gas. You have the full unit growth, should there be unit growth in their acreage. You get no operating expense, no real cost to run the wells. The operators do that, and they pay the landowners the royalty payments. It comes right off the top, so you're the first call on the income from the wells. Should there ever be a problem where oil prices drop a lot, you're top of the list. So what's not to like? It's if you need income, the 40-cent dividend, I believe, is very safe because they paid it last quarter, and natural gas prices were $1.88 when they realized the third quarter numbers. Royalties lag about 3 months, so you're seeing the natural gas prices from the fall when they were about $2.25. Right now, natural gas is 4.60. It's more than double. So in 2 quarters, you're going to be seeing royalties and distributions that reflects not their biggest asset, which is natural gas, that is going to have doubled in price, and I wouldn't be surprised if the distribution is higher than 40 cents a quarter, 41 cents a quarter for the next 4 quarters. It might be $1.70 the distribution for calendar 2025. So at $13.50, I'm pounding the table on this buy because the yield's too good, the balance sheet's too good, and I happen to like natural gas as a secular play.
Robert, what happened? What happened on earnings day? They this $2 drop. The distribution didn't meet expectations, or people were shocked that the nat gas price wasn't realized higher. What happened?
Exactly, people were shocked because we were following Henry Hub for the fourth quarter, which was closer to $3, and they had a revenue shortfall because of that. Now they did have $8 million in revenue that was not recognized, that was cash that was paid and should be recognized next quarter. So they had slippage from some large wells that came online in the fourth quarter, and that should be recognized in the first quarter. So I think they had a revenue miss. The EBITDA was in line, and two analysts downgraded the stock right after this, and that's put pressure on the stock as well. I think they have good coverage for a small cap. They have like 4 or 5 analysts. The 2 analysts that downgraded the stock didn't participate in the last large equity offering.
There you go.
They did a deal. The 2 guys that got stiffed downgraded the stock from buy to hold, even though the stock was already 14 and change, and they drove it down to 13 and change. So that's a stupid reason to downgrade a stock. But I'm willing to take advantage of Wall Street's ignorance in this instance and say that's a better buying opportunity. So again, it's a compelling yield in today's environment. Last time I looked at 10-year Treasury, which everybody had their bowels in an uproar at 480, is down to 424, and I don't see how you could lose getting 12%. Now, if oil and natural gas crash, enter a global recession, there's risk that the distribution could go back to 25 or 30 cents from 40 cents. And that's happened in the past. But as long as natural gas holds up on a secular basis for the next 2 to 3 years, I think, the dividend is very sustainable, even with oil at $65. So I would be a buyer of this here for income portfolios. A very strong buyer here at 13 and change.
What's the oil gas mix?
It's about it's about 40%, about 35% oil, 15% natural gas liquids, and 50% dry gas. So
Okay.
It's very, very gas rich.
Okay.
And this is one of your larger positions now?
It's in my income portfolio. It's an average position. It's decent size.
All right.
It's about 4%, so that's a nice size holding for me.
Yeah. So let's put on our running shoes to go get some mineral rights and head on over with Kevin to some sneaker companies. Maybe they sell other stuff other than sneakers. I don't know what that if I've ever seen a Nike logo on anything else but sneakers. But no, actually, what's interesting is the BNP Paribas Open's going on this weekend, and what you notice is Adidas, or Adidas, as we actually should say it, is everywhere on all of the players. Nike's on some of them as some of the bigger stars, but what you notice is that unlike in other years, you see Adidas a lot of places that you didn't see before. But so, Kevin, tell us a little bit about Salesforce, but then also Nike and OnCloud, or whatever that funny symbol is.
Okay, let's do the sneakers first, and then I'll go to Salesforce. And Jeff, I didn't mean to get you out of bed, out in San Diego. I apologize if I ambushed you with this. But
it's daylight savings, man. I feel like I should be in bed right this second. Go on. I'm sorry.
Anytime we talk about a stock, I put it in my system, and I literally I stare at it every single night after the close. And I had a very elegantly titled post a little while ago, "Shoe Stocks Suck," which was a big fan favorite. And I talked about Crocs and Deckers and Skechers, and On was still holding up. And ON is the symbol. So don't an aside, always put down the name and the symbol so you don't buy, On Semiconductor by mistake. Anyway, or short. But I just came across my caught my eye as I was going through it, and this has finally joined the other shoe stocks to the downside. I think it's a sale here up at 58 or so, and the volume's picking up. It's following through to the downside, and I just think that I think that, Jeff, there might be we might be reversing your theme of last year, which was get out of everything but Nike. But let me look at I want to show you Nike. If you squint, okay,
you can see a little base there, a little sexy.
You see
base.
this, and I'm always struck by this, okay? The volume, the up volume days are picking up, especially in this tape, where I think tariffs hit Nike, but this is starting to look interesting. I want to see this 200-day move up. I want to see the 50-day come through it. But this has been 9 months in the penalty box, and they might be getting out of it. So I'm thrilled that you're here because you've forgotten more about this than I know. But my eye is sell a third of On and put Nike maybe at the top of the pile and wait for buys.
Well, we've been talking about this for the last week or so, and actually talked about it on this show, talked about it at other places, that you're seeing a reversal. A couple points on this. One was that we started noticing that Dex broke the whole group. They came out and they said, Hoka margins aren't going to be quite. That stock got taken to the shed, and then it became a matter of, okay, is everyone getting impacted? It's what's going on here fundamentally. On came out, and I believe we talked about on their show, they were right around 50 when they reported. The chart looked miserable. They needed a huge quarter. They actually reported terrific numbers. Just like even the cynics, really, you just kind of had to acknowledge, both in terms of how they performed on a lagging basis. Christmas was a billion years ago, but on a go forward basis, there really was a lot of positive stuff going on there. Stock is stone cold busted. Stone cold freaking just a shit show busted. I completely agree on a technical basis. It's broken. Broken's broken. That's the whole point of the chart. It clearly didn't hold the 50 area, didn't hold support, didn't hold the uptrends. It's busted, just like that whole group is. I love what you're seeing in Nike. You know what else you're seeing? Pull up a chart of Starbucks. You're seeing that same type of action, only more so. Nike's kind of a poor man's Starbucks in terms of what the thesis is going on.
Starbucks, SBUX, you're talking about.
Yep. This is another one that you would think, what it has in common with Nike is you would think they would be murdered a million ways from Sunday on consumer discretionary, on China, on tariffs. The number of reasons that you have for Starbucks. They're in the middle of a turnaround. No one's really expecting great comps yet. That stock is still showing a pretty decent amount of resiliency, and it was another trade where you could just pick up the bros of the world. That stock's also reversed. They were picking up shares from Starbucks, but you're seeing a lot of those momentum names, man, in a market like this, in a tape that has just become relentless on the consumer names. Your upsides look like we talked about Gap. Remember, and it was like, Ben and I are celebrating Gap and kind of having a laugh on it on Friday, and the question came up, would we buy it there? Hell no, absolutely not. In this tape, are you kidding me? You're picking up nickels in front of a steamroller, and sure enough, Gap's down 5% today. It's a trading tape, even for the winners right now in consumer. The tariff stuff's bad. Once we got into tariff talk, it really kind of exploded February 1st. It exploded on the Google interest, whatever it is you track on how much attention people are paying. You saw tariff spike and you saw consumer discretionary start getting murdered. Those stocks are down 11% as a group since February 1st. That's not a coincidence. anytime, we're all kind of old bald guys, so we survived 2018. It's a tough time. When tariff random headlines are coming across your transom every 10 minutes or so, super tough time to own consumer discretionary. It's the exact kind of opposite of the catalyst we have in Nike Bakes. To your point, are they turning around fundamentally? Probably, and that would be a lot of earnings, but it's a nice, big, ambiguous, vague catalyst to the upside. Tariffs are the exact opposite. We don't know how meaningful they're going to be to these companies when you get done with it. We just know it's big. It's a negative. No one gets really benefits from it, and it puts off any type of spending that companies are going to do on any discretionary basis. And so you're seeing your reward for being in staples is you're maybe breaking even, or you're long Walmart and you console yourself with, gee, they're really good, but the stock's still down 15% in a straight line. Or you just gotta, you stay out of these things in short. We've got a lot of reports coming up this week. Dick's is another company that's doing terrific. And I would not be shocked at all if they get poleaxed tomorrow. And the way I'm trading it and playing it, I want to start buying that under 200. I want to start buying it on a pullback on good news. I think they're in another position. Dix and Kohl's are both reporting tomorrow. I've got to write up elsewhere, but just Kohl's could not be in a worse situation. But like we saw with Foot Locker, sometimes these really negative expectations are the best insurance these companies have, because anything that any optimism is priced into it, those are just getting taken to the woodshed, just absolutely beaten like government issue mules. And I'm not going to fight that trend. That's just crazy. I consider this a buying opportunity in wait, and in the meantime, kind of just a couple days to catch up on sleep. It's we're going to see a lot of more reports this week as we get deeper into the murkier corners of the shopping mall, the places next to the t-shirt shop and the arcades and the bookstores and stuff like that, the lower rent districts, the American Eagles of the world. They're not going to come up with huge quarters and say that the consumer's great. It's the consumer definitely fell off in February. When everyone tells me the same thing, I tend to start to believe it. In this particular case, and so it's playing defense on these stocks, at least for now.
Yeah, it looks. It's interesting because some of the stocks that I own, like let's maybe Baker, if you pull up, let's pull up Lifetime Group Holdings LTH. So, I've sold a little bit of this. This is they had a great quarter. You could look at all the fundamentals, but it's a very similar consumer discretionary type play, in that you have a high margin customer, and again, everything looks great, but if you're going to trade, now some people are going to be investing over the next, listen, I just want to know a couple stocks to own for the next 10 years. And this is a great stock for a 10-year play. But if you look and you say, well, what is the market saying about LTH? I don't know if you can pull it up, Kevin, but
Yep.
So you had a big amount of insider selling recently. Now it's very complicated. I reached out to the IR team, and they described it as like, look, the CEO is net increasing his shares, but because of options expiry and all of this, it looks like he's dumping a lot of shares. But they walked through the math. Well, I obviously wasn't the only one who was concerned about this, plus the market. So I don't want to overstate that people are dumping Lifetime Group Holdings. It's more to say, look, we're seeing this in a number of names, and this is one of them. Where you're not seeing it is that Pharma is really proving to be defensive. In the last week, Pharma's way outperformed. If you look at either Merck or Pfizer, Kevin, I don't know which one you want to pull up, but you could just see that there's been some pretty good outperformance recently. Today, they're acting great. Now, I wouldn't look at Lilly and Novo as proxies, because they're in the middle of this obesity battle. And so it's hard to say, well, what's obesity play versus the market. And Lilly is also the most expensive of the pharma companies. So if you're looking at pharma and you're thinking of, well, I want to just look at the group of things that were forgotten for the last 2 years. You think of Bristol Myers, you think of Pfizer, you think of Merck, all three of them with decent yields. You're not going to retire on those yields, but you have decent yield, great coverage of that yield. We mentioned that earlier of these are pharma companies. These aren't companies where you have to necessarily worry about the dividend, when you sleep. and they're acting a lot. They're acting a lot better. Very defensive names historically. They weren't that way for a little bit part of the year, but now they're really catching kind of catching fire, if you can say. But up 1.5% or 2% on a day like today, where the market's down 2%, that's serious outperformance. That gets every institutional portfolio manager saying, "Wait a second, I'm losing performance here. I'm underinvested here. I can't afford this," and so it kind of self perpetuates until it doesn't. And I think we're kind of in the early stages of that. So I've upped my pharma exposure. I've lowered my exposure to even HIMS. I'm out of HIMS. So I missed part of last week. So that's good. It's still a great company, multi-year thing, but I just want to buy it at a lower price. So I kind of just followed my own advice of, look, if I can get it a few dollars cheaper, why wouldn't I? Now, for people who aren't trading, then there's a different message. I try to balance that in my own portfolio of what am I thinking about longer term, what am I not? And HIMS is one of those longer term bets. But when you go from 15 to 40 or 70 at one point, you have to take money off the table. But the big news today, Lilly and Novo had some data out. That stock is getting annihilated today for a large cap annihilated. I had mentioned a while ago that the obesity trade was over, that Lilly had better data. Well, Novo came out today with some news on a pipeline product that was going to be kind of it was going to beat Lilly's drug, and guess what? It doesn't beat Lilly's drug, and so people are like, okay, so Novo is a market share loser over the long term now in the obesity market. And they'll still grow their own product, but they'll be losing share, and they're going to have to fight on price. You probably don't want to own something like that versus owning a Lilly that's going to just be, reaping all the rewards. Now, I'm not involved with Lilly. I said I'll buy it at 700. We'll see if it gets there, but maybe 750. But that's obesity today, today's news, and I think that you can see Lilly's not really up on it, which kind of tells you that the price. Oh, we're going to have to fight on price is also in the market. People are kind of probably concerned about that. Any other questions? Anything else anybody wants to talk about?
I want to go back to Salesforce.
Oh yeah, Salesforce CRM. What do you have for us?
It's a sell Salesforce. I'm not being vague. It is joining 4 of the Mag 7. This isn't in the Mag 7, but it's in essence a tech darling. And the 200-day is if you squint, you can see the 200-day is turning down. Actually, it turned down on Friday by a minuscule amount. But I've seen this movie, and I don't want to see the ending. The relative strength has blown up, and these stocks are for sale, and ought to be, in my opinion. The estimates are coming down, and you're going to have some bounces here. I think they're going to be feeble. But you've only got 3 of the Mag 7 that are above their 200-day, and those are being threatened. And now it's Salesforce joining Microsoft and Tesla and Google and Nvidia to the downside. So, and also, by the way, David, the biotechs, Amgen and Gilead, are gathering what the rest of the market is spilling, big time. So, fund flows are what drives this, and the PMs are getting tapped on the shoulder saying, listen, get your tech down and get your healthcare up.
That's what it looks like. If you look at the vaccine makers, Charlie and I had talked about this. He was a little bit earlier than I was on it. But we were talking about kind of bird flu and when will it turn into a pandemic? Will it? But if you look at like mRNA, that's up today pretty significantly. So you're right. It's seeing a little bit of steam outside of the traditional large pharma. But again, if someone's going to make a big move and you're a large fund manager, you look for large and liquid, and Moderna definitely has that. But also Pfizer, Bristol Myers, Merck, kind of the easy to go to, AstraZeneca, easy to go to names. Well, with that was a busy Monday. little bit busier than I like to ease into the week. So this week is the Barclays Healthcare Conference down in Miami. So I'll be getting some sunscreen. I'll be joining Robert down in Florida, and everybody else. I hope that you don't freeze where you are, but have a great week, and we'll see you tomorrow. If you're interested in getting more of this and even more detail on our chat and in our written product, just go to wallstreetbeats.com and subscribe. It's a 14-day free trial. You'll get 14 days of sweet goodness, I guess. Thanks, everybody. Have a great week.
Thanks for joining.